Hello, so now we're going to continue to calculate more important data for our decision. First, we're going to calculate our before tax equity reversion. We will need a future sales price less selling cost and that will equal our net proceeds from sale less loan balance, and that will equal our before tax equity reversion. So our future sales price equals our acquisition price from page 1, acquisition price times 1 plus our appreciation. Now for future for selling cost, we have assumed a 6%. So we will equal future sales price times 6%, and for our net proceeds from sale, we will do future sales price minus selling cost. For loan balance, we will go back to our amortization table where we will put our loan amount minus the summation of all the principals resulting from the amortization table we build, and this answer will be equal to the loan balance at this point. So we will go back to loan balance, and that equals to and then finally for before tax equity reversion, we have net proceeds from sale minus loan balance. Now we're going to continue to calculate capital gain. For capital gain, we will need our net proceeds from sale, which we have already calculated. Then we will need our original basis, which is our acquisition price. We will need less depreciation taken, which we have also calculated already, plus improvement expenditures, and then finally we will have the adjusted basis, which will be helpful to calculate the capital gain. Our net proceeds from sale equal, we just calculated net proceeds from sale, our original basis equal our acquisition price, our depreciation taken is equal to the summation of the depreciation straight line that we calculated in the taxable income. The improvement expenditures is in the very first page. And then finally, for the adjusted basis, we will have original base minus depreciation plus improvement expenditures. For our capital gain, we will have net proceeds from sale minus adjusted basis. Let us format these numbers. Now we will calculate our capital gain tax. We will make again a chart that shows everything we need to know. We will calculate capital gain on appreciation and also on depreciation taken. For our appreciation portion, we are going to do 15%, and for our depreciation 25%. Our depreciation taken equals, we have already here, and then our appreciation portion equals our capital gain minus our depreciation taken. For our tax calculation, we will do our gains times the percentage on tax. So equal gain times percentage in tax. We will go ahead and do the summation of all these taxes. Okay. Now we're going to go ahead and do some calculations for the decision criteria. First, the initial equity. Which is the initial investment that we will have to make. It equals the acquisition price minus the loan amount. Okay. Now we're going to go ahead and build another chart that will include our after-tax cash flow periodic. It will also have our before tax equity reversion, our tax on capital gain, and finally our after-tax cash flow total, which is pretty much our cash flow for the whole problem. From previous charts, okay, we're going to move this information a little bit lower so we can build our chart. We'll have for year 1, for year 2, and also for year 3. Our after-tax cash flow equals from previous calculation, and then we can just drag it down the line. Then our BTR will be put in year 3, and we just calculated it in this sheet. Our tax on capital gain equals the summation of the tax on appreciation and depreciation, and we will also put it in year 3. And then finally, for our cash flows, we will do the summation of all these numbers in each year. Okay, now we're going to calculate our present value factor. For our present value factor, we will do equal present value. Our rate equals the investor's required rate of return, which in this case is 10%. Then we need our periods. First one will be 1, our payment will be 0, and then minus 1 for future value. We'll drag this down for the 3 years. All these are numbers. We will have to, before we go back and secure the rate, this is a number, then we can drag it down again, and then we will have to change the number of periods. So for example, from 1 to 2, and then from 2 to 3. Finally, we will be able to calculate our present value benefit. It equals the after-tax cash flow times our present value factor. And finally, we will have a total present value, which equals the summation of all the present values we just calculated. Let's change these to all $signs. Now we're going to calculate the net present value. In this case, the net present value equals our total present value minus our initial investment. From here we can already say that we will do this investment because the net present value is a positive number, but we're also going to make sure that our decision is right by calculating the IRR. For the IRR, we will have to put at the beginning of the cash flows, we will also add our initial investment, which equals minus, because it's an outflow, our initial investment. Now for IRR, we will just go ahead and say equals IRR, and then our values will be starting from the outflow all the way to the cash flow in year 3, and our IRR is 15%, which is higher than our investors' required rate of return of 10. In which case we will say, should I invest? Yes, invest. We can also use a function if. So if total present value is greater than initial investment, then say yes, good investment, or say no, bad investment. So in this case we have a yes, good investment, go ahead, invest, is awesome. Now we're going to, in this last couple of minutes, we're just going to go ahead and format our Excel sheet. We can change colors, we can mark our answers, the most important answers we have gotten, and just make it more presentable. Our capital gain tax calculation, very important. For gain and tax, we can make a grid. This is one of the numbers we used. For our investment also, the decision criterion, very important. And then finally, let's format our charts. Present value, another important number. And finally we have NPV and IRR. For result, we can go ahead and just make our sheet look prettier. There we go. Now for sheet number 2, we can also do the same thing, make tables for all of these values we have calculated. Now that we know what this means, we can get rid of this. Yeah. So in conclusion, this is a good investment and we will invest in this small apartment. Thank you for watching.